Now, we always like to begin briefly with our recently posted content and discussions. This week, we posted a few videos here. From last week, you had the risks of double diagonal as an earnings play, discussion on implied volatility and market volatility. We had a new feature that we discussed, setting up a specific search criteria on power options there, and a new feature that was discussed. Then we had some questions from our last Friday session. Why is the market going up when everything is negative? A little follow-up to the risks of a double diagonal as an earnings play, how it can be profitable, but how it can also work against you, even if the stock does what you expect to do with that strategy. And we just put a brief 8-minute presentation together for you to walk through the 5 or 6 tools to help you evaluate bull call debit spreads on power options. We might pick that up with a discussion on management techniques for bull call debit spreads sometimes during today's presentation as well. Of course, also on our YouTube channel, we encourage everyone to check out the playlist that we have made available for you. Various strategies, everything from debit spreads, credit spreads, simple strategies, covered calls, buying puts. These 9 or 10 videos in each section sort of walk you through the introduction to the strategy, criteria that you can use, how to set up the search for what you're looking for, exit strategies, exit triggers you might want to look for, management techniques, and more. So they're quick walkthroughs of each of the strategy to go through the basic points from starting to managing and beyond. So you want to check those out if you're just starting out, looking into a new strategy or trying to develop a new strategy for your trading plan based on current market conditions. And speaking of that, just a quick reminder for everyone, the markets are closed on Friday, this Friday, April 15th. In honor of Good Friday, of course, Easter weekend is coming up. So the standard expiration will, of course, actually be on the 14th. So expiration is going to be on Thursday, the 14th, the standard April expiration, as the markets will be closed on the 15th as well. All right, all that being said, we're just going to pause the screen now. We're going to go ahead, perhaps, and navigate over to the Power Options suite of tools. We'll, of course, be using these tools to help us with our discussion for today, illustrations for the questions that you guys bring us. So I want to encourage you to ask any questions at any time as well. We see that the market sentiment is still in neutral with the recent performance. This will probably update sometime around 4:45 to 5 p.m. Eastern Time for the April 8th. The market sentiment tool only updates at the end of day, once per day. So we might go ahead and take a look at that in a little bit and see what we have. All right, I'm going to use the portfolio for this, Edison, because there's a lot going on. So let's go to the portfolios real quick, and I'm just going to create a new portfolio here for TQQQ. And the date initially was around, you said April 8th. Oh, okay, so I got to go further back here. Let's go to, it doesn't matter. Let's go back into March. Okay. All right, so just created that portfolio for TQQQ. And we're going to enter a strategy here. All right, so looks like you started out with a married put. That was the wrong button. TQQQ. Let's put March, whatever, 30th. There we go. At 60. And you bought to open an April 8th 65 put. $330 at $540. Okay, so initially, what can we say about this position? Well, all right, it's a low risk of 0.6%. I don't know what date you actually opened this, Edison. I'm using it about 7 to 8 days out, simulating that maybe we did this on March 30th. We're going to take a look at the stock chart in a moment. So you have a low risk for only 6 to 7 days to trade on this position. Now, let's just take a look at the charts here. Yeah, so I was close, I think. You're probably April 1st or April 2nd, somewhere around that time frame, right around the 31st. I put the 30th, but I think you're probably more around the 1st or the 2nd of April when you bought into it, and the stock, a TQQ, excuse me, dropped down in price. There's the Ultra Pro QQQ. So we're seeing some losses here on this position as the market pullback. Same kind of stock chart, almost identical. We saw it on Kohl's, right? The last 3 days on that review we just did, it dropped down as well. Okay, there's the first thing, analysts, you know what I'm going to say. It's not my approach. You did a short-term married put on an Ultra ETF. I get it. I get why you were trying to do it. But you know, when I do a married put, we try to put the time decay factor in our favor. We're going out maybe at least 120, 130 days at a time, following the radioactive trading techniques. We're not using it as a short-term trade. Your good range in the money, of course, with a 65, so you only had 40 cents extra above that, but your break even was 65.40 when you bought the stock at 60. So you're expecting about a 7 or 8% gain over that time period to see a profit. That's a little aggressive for my tastes, but if that was your sentiment, I get it. You did have a low controlled risk, I understand that. But remember, the break even here, as we saw back on the profit and loss chart, would have been 65.40. So yeah, we're expecting sort of that, 7 to 8% movement there from 60 where you bought it just to get to break even. That's pretty aggressive, but it's an Ultra, so makes sense. Now, things changed. Don't know the dates, but probably recently, in the last few days or so. Let's go back to the portfolio. You rolled this position effectively. You sold to close the April 8th at 13.15, probably in the last day or two, yesterday or today, and then you bought to open the 53 put, April 14th, 53 put at 297, pretty close to where it is right now. Not too far off. All right, so we're going to say we did this yesterday or today. Let's just put it today. Stock price probably around here, 51.84, maybe a little bit lower. All right. Okay, so what did that do? Now that lowers our cost basis on the stock down to 52.25. We're holding a 53 strike put at 297. This 52.25 effective cost per share is taking into account the profit from the closed put that you had. And you've got a 53 put at 297. So now let's take a look at the new graph with our new effective cost per share. You took your risk up from 0.6% up to 4%, with possibly 8 days to go to expiration. Your break even is at 55.22. We've lowered that by about 10 points from 65.50 to 55.22. But now you're expecting the stock to recover and move back up from 52 or 51.84 up to 55.22. Let's just call it a $3.20. Okay, let's call it a $3.40 movement where the stock is now. So it's probably only about a 6%, 6.5% gain to get back to break even with moving this put and sometime in the next 6 to 7 days. Again, as I mentioned, you still need the stock to go up to 55.22 at this point in order to break even. But then we've got one more adjustment. And what you're going to do here is when the stock started to recover at one point, let me go back, a brief recovery there. So let me go to a 1 month. I'm sorry, maybe even 10 days. Let's do that. Is it going to ask me to change? Yeah, it is. Let's go hourly. There we go. Okay. So what I'm thinking that you did is that when it started to fall, of course, naturally, this is where you did that first adjustment and moved the put down. And then when you started to see this or this here, you move the put back up. I'm sorry. Yeah, you moved the 65 down. You moved the 65 down to the 53. And you did that during this time period. And now when it started to move back up, you did another adjustment. You're going to roll this one back up again. Okay, so let's go back and take a look at that. Okay, so we know where we are now. Right now is not where we are. Right now, we're at a break even of 55.22 with a risk of 4% on the position. You started off with 0.6% for 7, 8 day trade, 6 day trade. Now we've extended the expiration going out further, and you move the put once again on TQQ. Let's roll this once more. And your last move, you sold to close the 53 at 225. So is it a higher price than it is right now, likely? And then you bought the April 14th 55 put. You said 350. Okay. Oops. All right, don't know what the stock price time of trade is. We're just going to assume it's again today. It doesn't matter for the recording. So what have we done now? We've got our position to 52.97. That's your effective cost per share on the stock, including the profits and losses on the positions. You did lose 70 cents or 72 cents on this last roll when you sold to close the April 53 at 225 because you originally bought it at 297, but you took in the $8 profit or so, 760 profit from that first adjustment. So we've got our new effective cost per share at 52.97. You're holding a 55 at 350. So again, rolling up the put in this case, I'm sorry, go to the profit and loss chart, cut the risk down not quite by half. You dropped it from 4 to 2.6%, and the break even changed from where you were at 55.22 to higher to 56.47 now due to the new cost. So you've gone back to the lower risk. It's still almost 6 times your original maximum risk of 4 times. It was 0.6%, I believe, I think. There's 4 or 5 times higher than you initially started, but lower than that first adjustment you made. But now you need the stock to go up just about 5. I'm sorry, folks. Yeah, just about, under 5. 480, 460. I'm sorry, 460. So again, to next week's expiration, you need again about an 8 or 9% gain just to get to break even on this position. So what you did with these adjustments is you're still pushing the ultra to still need to see 6, 7, or 8% gain to hit break even in 7 to 8 days. Is it possible? Yes. The way the trend's going, not so sure. The debate here is, you're asking me to analyze the position, so I'll say this in analysis. I already mentioned what I would do differently, but you know that because I'm looking for a longer-term play, not a shorter-term profit pop using a married put approach on an ultra 2x or 3x ETF. There's nothing wrong with doing that. I understand it. But what you've done here, Edison, you've taken a small risk of 0.4, 0.5% or so, increased it tenfold to 4% with the one movement, and then managed to lower it down to 2.6% and given yourself 8 more days both times, but you're still now in a position where you need 7 or 8% gain to get back to break even on this position. And if it doesn't do what you want, then you're going to have to roll it again next week, and you have to roll it again maybe the week after. Hopefully you get a jump and you see the profit. Where I'm going with this is that you might want to ask yourself, would it have been better just to take the initial loss on the trade that didn't work out with that low risk of 0.4% rather than only extending it 7 days, putting up the risk tenfold to 4% from 0.4 or 0.6, whatever it was, managed to lower it again to 2.6. But if you still have to keep managing because you're not hitting the break even though you're in an ultra, you need that 7 or 8% move on the position, Edison. Would it have been better maybe just to take the 0.4%, 0.5%, 0.6% loss on the first cycle and then just opened a new position later with the same maybe 0.4, 0.6, or 0.7% risk if your sentiment was still bullish with that structure? By doing these rolls, I fear that you've increased the risk too much with too short of a time frame and now need too big of a move. Again, it is an ultra. I understand that. But you see how the movements you jumped. We started off with your original trading plan, perhaps, of having only a risk of less than 0.5% when you originally opened the position for 7 days, 8 days of trading. Now you've extended it out another 6 or 7 days from today. It's the 14th technically, so we're really 6 days away. And you have a much bigger risk, and you need a much bigger move to get back to break even. Well, it's about the same, really. We're still at that 7 or 8% move, but you're taking on a higher risk if it doesn't. And each time you have to extend it, I doubt it'll happen, but if you see here, it hasn't in the last 2 days, it's waffled right in this, it's moved down, but it's waffled right in this 54 to 52 range. If that continues to stagnate, you're getting closer and closer to that now 2.6% loss. If you extend it again, the loss is going to go up to 3.5%, maybe 4% again, which means you're going to need to see a bigger movement to the upside in order to get to the break even. So That's what I see with this position. I'm not going to say that it was overtraded. I see what you were attempting to do with the position. I see why you were applying these adjustments to this position. I do like the move going back here to taking the risk back down to 2.6% from 4%, but it did unfortunately raise the break even. You've only got 6 days to go now for the stock to reach that direction. Again, I'm not going to say that you overtraded it, but maybe if I opened a position that had that small of a risk to begin with and I was comfortable with taking that small risk and the stock didn't do what I want, maybe I just would have let it go and taken that 0.4, 0.5% risk in that case, realized that loss, and then maybe open the position again on Monday with buying the stock at 51.84, maybe buying the 55, and let's see what that would look like. Oh, it's right here. But let's say my cost basis was 51.84. So I've already realized that 0.4, 0.5, 0.6% loss in the first trade. This is only a 0.6% loss. If I know Monday's the price is going to be different, Edison, I understand. But if I did get these prices for these positions, let's get the actual 55 price for April 14th. It was a little higher than 350, wasn't it? Yeah. Let's do that. 385, 420. Let's just call it 405. There we go. Maybe that's going to look a little bit better. Oh, shoot. Oh, they call it 4025. I'm just going to call it 405. All right, so it's close. So I take that original 0.4, 0.5% loss, the new max risk of opening it. If I had taken the 0.4, 0.5% initial loss, Edison, reopening on Monday would have been 1.6. So the maximum loss is 2 to 2.1%. Whereas your position now is at 2.6%, a little bit higher, 0.5% higher risk. We call my break even, let's say 55.89 if I could get these prices on Monday, which we know we won't, but just as an example, versus the roll to the 2.6% risk that you had. The break even was about this. Oh, it was 55.20. Oh, no, that's the other one. I'm sorry. Let me go back here. Sorry, folks. Is it 56.47 versus 55.89? Okay, so a little bit less, a little bit better, but that's just one thing that I'd mention is that if you start off with a position like that that's so short term, you have such a low risk, it might not be worth it to overtrade it and keep adjusting the puts just 1 to 2 weeks out because you increase the risk a little bit higher than you would have had you just taken the initial loss to begin with and then maybe reopen the position. That's one thing to consider in that trade. You did lower it down to 2.6 though from 4, which is good. It'd be hard to take a 4% risk carrying into next week on the shortened week of trading. We'll have to see what activity we get there. Could very easily hit any of those break evens. I get it, being an ultra, but that's just my thoughts, Edison, on what you did with this position. Taking a look a little bit of why you did it with the stock chart that we saw there. It makes sense. I understand what you're doing. But it's really quick movements, and I know why you're doing a really quick movements on an ultra because you're looking for the quicker pops with the ultra QQQ. It didn't do what you wanted, and it stagnated the last 2 days. So again, those are just my thoughts on the analysis that you gave me there for what you did with that approach. All right, well, we only really covered 2 topics today. It is 5:33 p.m. Eastern time, but if anyone has any last-minute questions, go ahead and send those in. As I mentioned in the beginning of the presentation, we stayed at neutral with the market sentiment. We had 0 bearish for the close of April 7th. Let's take a look at the history there. Yes, on the 7th, we had 0 bearish, 2 bullish, and 11 neutral, and that shifted now to 12 neutral and 1 bearish with no bullish there on the market sentiment. So it hasn't actually triggered a new movement to the bear side, but the last signals were the bearish sell warnings that we saw back on 329 and 330, which sort of came to fruition a little bit. I mean, we saw, I'm not going to say that was the morning, but we did see the pullback there from the 46.31 down to 44.81 here. And then we've seen some hesitation. It's still at 44.88 at the close in that case. So not overly significant, but still a little bit decline there. We'll have to see where the triggers go next as we came off of that rise. But I just want to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. Options do involve risk and may not be suitable for all investors. Now, we did have a chance to cover the portfolio tools today. We saw that in action. We didn't go through the search tool, but we've covered that in a lot of previous presentations. Spent most of the time today reviewing the 7 ways to manage a bull call debit spread. But if you like some of the tools you saw today, remember you can take a 14-day free trial to Power Options at any time. Just go to powerup.com, put in your name and email address. No credit card required. You'll have full use of the site for 14 days. After that, the subscription services start at just $45 per month for the end-of-day data service. The delayed data, where the data is updated every 15 to 20 minutes, is only $65 per month. Of course, you can upgrade to the delayed service plus historical for just $35 more. You'll have full access for the 7.5, 8 years of backtesting historical data and 20-minute delayed data for $100 per month only. And of course, there's upgrades to the full real-time service and the premium service, which includes everything as well. Other education is always available at any time. You can go to powerup.com and go to the webinars page and scroll through with different webinars on the tools, option strategies, concepts, requested topics, and more. Or you can go to the YouTube channel there, check out the playlist, or just use the search function to search videos on Poor Man's Covered Call, Delta, implied volatility, covered calls, any strategy you're looking for. You'll just see the list. But of course, most of those playlists are organized there already for you. And of course, if you think of any other questions at any time, I didn't see any last-minute questions come in, just send us an email at any time. You send us an email to support@powerup.com or support@radioactivetrading.com. You can call us during market hours at 302-992-7971. And of course, anyone who's on a trial or a subscriber can schedule a free coaching session. That's essentially a 35 to 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site and answer any questions that you have. Similar to what we did today, but it's usually done over the phone. However, if you want to, when you schedule a coaching session, you can request a screen share, and I'll use the GoToMeeting, GoToWebinar platform so you can see the screen and see me interacting with it to answer your questions, just as we did today, and we do every Friday as well. All right, quick reminder, markets are closed on Friday, April 15th, which would regularly be the 3rd Friday of the month, standard expiration. Standard expiration is now Thursday, April 14th, due to the Easter holiday, of course. So don't wait till Friday because the markets will be closed. Got to do your adjustments by the 14th for anything you have expiring coming up this week.